So I thought I'd kind of talk about two things to start off with, how people in the rest of the world, in Europe in particular, and probably the UK in particular within Europe, think of the existing system, where it's been going, and then actually talk about potential reforms, but in particular the blueprint that Barbara Angus was just talking about. So that's the plan. So I think and Bob has already said this much more eloquently than I could really. So there are slides here. I realise I'm kind of sitting in your way, so I hope you can see them behind me. So there's a common perception that the US goes out of its way to help US multinationals not pay any tax anywhere else, and the things like check the box provisions and so on, are ways in which it aims to do that. I think this is certainly a commonly held view. I think a lot of the work that went on in BEPS was responding to those kind of views, and the OECD thinks there's a problem of what they call double non-taxation, or what anybody else might call no taxation. So what and the way that it works is the US multinationals are active around the world, but they can, as Bob said, you can pay royalties to a tax haven. You get tax relief when you pay the royalty from normally from the country in which you're paying the royalty. The tax haven is a tax haven, so you're unlikely to be paying much tax there. In principle, that money will be taxed when it comes back to the US. In practice, I imagine multinationals are waiting for another tax holiday, and so that they can bring it back at a relatively low rate of tax. That's certainly how it's perceived. I think there are questions. I think that now we're into effectively the implementation process of the BEPS project. We in the UK are busy introducing some elements of the BEPS project. I think there's certainly question marks in the UK and elsewhere about how far that's going to go within the US. And, Bob would again know much more about that than I would do. I guess there are issues there that there's been quite a big dispute about Apple and Ireland, and the European Commission's view in trying to take that as a state aid issue. So the state aid issue from the European perspective would be that Ireland has given preferential treatment to Apple, and therefore it's a competition issue. It's not a tax issue. I'm presenting the European Commission's view here. So if it's the case that the Irish government has given preferential treatment to a particular company, then that may fall foul of state aid rules. Now, the way in which the Commission is interpreting the tax provisions to make that is somewhat questionable. I would say it's now subject to appeal. The Irish government is going to court to try and not collect 14 billion euros from Apple, which is quite an interesting political judgment. But with respect to the US, so the US Treasury released a paper basically complaining about this whole process, and saying it's unfair, we're picking on American companies and so on. So I thought, as a view from outside the US, I thought I'd better report that the rest of the world may think that's a pretty aggressive attitude from the US to complain about the European Commission trying to implement competitive processes within the EU. However, some caveats to this. That was kind of what I think other people think. This is some caveats of kind of my own, really, with respect to that. It's not really clear why double non-taxation is a problem to start off with. And if you have a US multinational that's operating in the UK, is making profits, the UK system says, if you pay a royalty to whoever owns, the intellectual property you're using, you get tax relief in the UK. Fine. So what? So what happens then if it's taxed? It may be taxed in the US. It may not be taxed in a tax haven. It's all certainly complying with the UK tax system. So it's not clear to me why anybody in the UK or anybody else should necessarily complain or even worry about the fact that it may have been not be taxed anywhere else. Second point would be actually, as Bob said, and suggested maybe a bad thing, but it is certainly up to those countries elsewhere in the world to do something about it. If they don't like the fact that the royalty is not being taxed anywhere else, then don't give relief for it, and that's up to them. That could be some kind of minimum tax, but it's not exactly saying it's all the fault of the US, although that's certainly how it's kind of presented many times. Some of the empirical work we've been doing in the Centre for Business Taxation is that we have access to tax returns in the UK. So these are these are corporation tax returns. We have, this is the population of corporation tax returns. Some of those tax returns are from affiliates of foreign multinational companies, and some of those are affiliates of American multinational companies. This is kind of very preliminary evidence, but the preliminary evidence we find is actually it is true that affiliates of foreign multinationals in the UK tend to pay considerably less tax than comparable domestic companies. So that's kind of, that's consistent with multinationals being able to shift profits around. What we didn't actually find was that there's a particular problem of US multinationals compared to multinationals from anywhere else. So German multinationals pay as little tax as US multinationals do, but they're all paying quite a lot less than UK domestic firms. So I guess the way that one looks at this really kind of depends on where you start. It's certainly the case, as we believe, and I think everybody else has said, multinationals manage to arrange their affairs so they don't pay that much tax, certainly on international activity. And to some extent that is, enabled by some of the US tax rules for multinational companies. How one responds to that, I think, depends on where you start looking. I think the other element of the US tax system which people take note of is the US is not a competitive place as a location for actually doing your business because of all the other things that everybody else is saying. It's got a high tax rate, tries to tax worldwide income. Because I think Ed said it doesn't tax worldwide income because of deferral. So in principle there's a tax on worldwide income. On the other hand, the fact that there has been at least one tax holiday on when dividends are repatriated to the US means that that induces multinationals to leave their profits abroad, as we know. So there's huge amounts of profits not coming back to the US and not being taxed in the US. So in a sense, there's kind of the worst of all worlds here. You've got high tax rate, and if you really did want to come to the US and do your activity rather than go to Canada or Mexico, then you'd be subject to a high US tax rate. If you wanted to incorporate in the US and do business elsewhere, then you'd be stuck with paying the US tax on repatriations back to the US, and even if you're a foreign owner of that company. So if I, as a UK citizen, wanted to set up a UK company to do business in Australia, then I'd be taxed in the US on that money coming back, and I'll come back to that in a bit. So on the face of it, that's not a good idea. It would be stupid for me to try and set up a US company in between me and the UK and my business in Australia. And therefore, the incentive is not to be an American company. That's why the US needs anti-inversion rules. But this is like kind of saying, what are we doing with anti-inversion rules? We're saying, okay, there's a lot of companies here which are already US companies. We're going to kind of lock the door, kind of bolt it several times, and every time they kind of think of a way of unbolting it, we're going to put some new bolts in. What are we doing there? Well, we're taxing old capital. We're taxing the profits of companies that are already profitable in the UK. Any well-advised new company which is trying to set up in the future, then the next Google or the next Facebook would be well advised not to set up a US company in the first place, and then they wouldn't have these anti-inversion problems. So, okay, that's a common view as well. So my take on that is this view justified? Then, actually, yes, I think it probably is. I think there are kind of issues with several elements of that tax system. I mean, one which I have greatest respect for Ed and Thornton as well in kind of thinking about how we should kind of redesign and refocus the US tax system. But I kind of do worry about trying to tax worldwide income just on the basis of you've got your headquarters or your parent company in the US. And there's some interesting statistics here which come from Steve Rosenthal and Lydia Austin from the Tax Policy Center. So, and actually the share of corporate stock owned by US individuals in personal taxable accounts, and on their accounts it was 85% back in the mid-60s, but now it's about a quarter, it's 24%. And 26% of US corporate stock is owned by non-residents. The rest is owned in tax-preferred accounts like retirement accounts. So actually, if we think, we're having a worldwide system because, we've got a personal income tax system which taxes worldwide income. We need a corporate tax system to, back up that personal income tax, and therefore that needs to be on worldwide income as well. I think, these statistics kind of cast doubt on that idea, I think. Incidentally, in the UK, it's much worse, if you like. 54% of UK stock is owned by non-residents, and only 12% is actually owned by taxable people in the UK. But this is a trend. My prediction would be the US is moving in this direction. It's continuing to move down, and the further we're trying to kind of tax worldwide income in the US, the more these statistics are going to go against that, I think. Why else might we want to do it? There's an argument for capital extraordinary neutrality. We don't want to kind of distort where US companies do their business. And if there's a kind of bottom line of US tax wherever you go, then that would be a good thing. Of course, under the existing system, that's hardly working, though. I mean, we think US companies are paying much less tax on their outbound investment than they are on their domestic investment. So, we're a long, long way away from capital export neutrality. I think Ed would argue, this is good for combating tax avoidance, and that's true conditional on being a US company. I think my concerns are much more to do with, we're placing an awful lot of pressure on kind of US residence rules here, if that's the basis for, for the tax system. Okay, so those are comments on the existing system, really. So this is kind of mostly about tax reform, so I thought I'd say something about that, and in particular about the blueprint, the proposal by the Ways and Means Committee. And essentially, as several other people have already talked about, is essentially a destination-based cash flow tax. Now, this is something that I personally have actually been working on for quite a long time, like about 15 years or so. So I'm delighted to see that it's come out of the ivory tower, and actually other people are talking about it as well. Well, I say proposed, it's been proposed by an Oxford group. This was somebody else who called it an Oxford group, but there's been a group of lawyers and economists that I've been chairing over the last 2 or 3 years, which has been trying to think about, how should we think about international tax reform? And this is one of the things that we've thought about quite a lot. So I should say that Mick is one of the members of that group. The other economist is Alan Auerbach, and we have 4 lawyers who are Michael Gratz, Paul Oosterhuis, Wolfgang Schön from Germany, and John Vella from the UK. So that's the group. So I thought I would go, into a little bit more detail than Barbara just did about, what the, I think I'm allowed to say what I like about this. I'm not really constrained by politics. So let me say something about what I think are the benefits of this. I think this is a kind of very interesting idea. So the cash flow tax, we've talked about that a lot. I mean, the basic idea would be we replace depreciation provisions with immediate expensing. There are issues about what we do with financial sides. Our proposal within our group, I think, would be primarily just to tax real flows rather than financial flows. There's what the Mead Committee called the R base as opposed to the R plus F base, the real plus financial. But in order to kind of have some tax on financial companies, our proposal, I think, would say we need to tax financial companies on their transactions with non-taxable entities. So actually, if you try and tax banks and other taxable entities, US businesses on their financial flows, they all net out anyway, really. So a tax on just real flows rather than financial flows for most of the economy would work fine. We'd need to supplement that, I think, with a tax on banks just for their transactions with individuals primarily, or other tax-exempt entities. So that's what it would be. Why cash flow taxation? Well, this is something that economists have advocated for 30 or 40 years, or possibly even longer. The idea is that it, as has come earlier in the discussion, it falls on economic rent, but not the normal return to capital. So, it shouldn't discourage the scale of investment. It shouldn't discourage investment conditional on the location, at least. It would be neutral between debt and equity finance. There's some simplicity there. We don't need to, therefore, keep track of the difference between debt and equity finance, and neither do we need to keep track of the value of assets as under depreciation provisions. So those are the kind of cash flow elements. The much kind of more radical element, though, is really the destination-based idea, which is, it's in the blueprint. So the idea of this is very much along the lines of VAT, and a VAT is generally levied on a destination base. It may be that you're not all quite as familiar with VAT as everybody else in the rest of the world, but everybody else in the rest of the world has got one pretty much. So how does that work? And basically what we propose, or what would be proposed under this, is the place of destination is essentially the place where you make a sale. Now there's kind of lots of technical issues about exactly what we mean by that, but that's the basic idea. If you have a kind of US producer that kind of sells a good to me in the UK, then that income is generated in the UK and will be taxed in the UK. That's the place of sale. Now, why is that an interesting idea? Why might that be a good idea? Well, because actually the tax is being levied in the place where the consumer is, and we're thinking about third parties here. So, third-party consumers are generally not going to move there, where they are, in order to help their, supplier save some tax. So, and we're thinking primarily about individuals. So that's a kind of relatively immobile tax base. It's going to be very difficult to start shifting profits that way. How do you implement that? You can implement that. The border adjustment bits, just like VAT. We say if you have a US producer selling abroad, that export is not subject to tax in the US. So exports are zero rated. However, conversely, we will tax imports coming into the US. The difference between this proposal and VAT is really the treatment of labour costs. So VAT is a tax on value added. That's equivalent to tax on economic profit and on the return to labour, so wages and salaries. What this tax would be to give relief for those labour costs. It's just a tax on the economic rent, just a tax on the economic profit. And under such a system, you can ignore foreign activities. I think Barbara described it as a kind of territorial tax, but it's not really a territorial tax in the normal sense that people think of it. I think of that as being it's a tax on activity taking place in the US, and we're not going to be worrying about activities taking place elsewhere. This is a destination tax, which is completely different, and this is a very radical change from existing systems. One aspect of that is when we're thinking about imports by US businesses, suppose this is implemented in the US, then there's two offsetting effects. One is because it's an import into the US, it should be subject to US tax. On the other hand, if it's imported by US business, then, and that's an input into that US business's activities, it's a cost to the business, so that cost to the business would be deductible in the normal way like all other costs. So those two elements of the tax would net out exactly. So there's a tax on the import, there's relief for the cost of the import, those two net out to zero. So certainly in many cases, a simplifying aspect of that is we wouldn't actually need to keep track of imports either. So we would neither tax them, nor would we give relief. And thinking of it in that way, you can actually see why this has a lot of nice properties with respect to profit shifting. So basically, we're saying intercompany transactions are just not in the tax base at all. So all the kind of transfer pricing stuff that we kind of worry about at the moment are basically going to not be in the tax base. So if if a US company sells to an affiliate abroad, that's an export, that's not going to be part of the US tax base. If that affiliate sells something to the US parent, as I've just said, that's not going to be in the tax base either. So there's no point in manipulating prices because it's not going to affect your tax position in the US. And if other countries did it, it wouldn't affect their tax position either. So the capabilities of profit shifting are very much lower within this kind of destination-based tax. So one other thing we could think about is, for example, royalty payments. Suppose it's the other way around, that there's a company with intellectual property in the UK, and there's a company in the US which is making use of that intellectual property and paying a royalty to the UK. Now, under the existing system, broadly that royalty would be tax deductible in the US and would be taxed in the UK. Under this system, it wouldn't be. That use of that intellectual property in the US is like an import into the US, if you like. So it should be taxable. On the other hand, it's tax deductible because there's a cost to the US. So we just ignore that royalty payment altogether. So again, many of the ways in which profit is shifted to tax havens just kind of drop out of this system. In principle, it's neutral with respect to relocation decisions as well. That's kind of mainly because you're being taxed where your consumer is. You're not going to be taxed where you do your production, and so actually it's neutral with respect to production decisions as well. There's kind of more to say there if anybody wants to challenge me on that, but let me kind of move on. And because of primarily because of incentives with respect to profit shifting, there's kind of whole swathes of the tax system we can just get rid of. We're not going to distinguish between debt and equity. We don't really need to worry about transfer pricing rules, think-out rules, CFC rules, because all the things which is trying to those rules are trying to guard against just wouldn't be relevant within this system. So let's just kind of think briefly about the tax system properties. But I'm conscious of the title I was given, which is the kind of view from the outside world or the rest of the world. So I really want to think about this in the context of, well, suppose the US did this. How would the rest of the world think about this, or what would be the impact on the rest of the world as well? The first thing to say is what we've done is to take the existing tax system, by these border adjustments of zero rating exports and taxing imports. We're basically saying, look, there's no tax on domestic source activity. If you produce in the US and sell somewhere else, then you're not going to be taxed on that income because that's zero rated exports. Only the location of purchases matters. So what is that doing? If we think about kind of, I think you put up a slide right at the beginning of the way that corporation tax rates have fallen over time. Now, corporation tax rates have fallen over time because there's been a very strong process of tax competition as governments compete both for real activity and for profits. What would this be doing? This is like a kind of leapfrogging, dramatic move in the tax competition game. It's saying, okay, we're going from a tax rate of 35% on your activity in the US to 0. And actually, it doesn't matter what the tax rate in the US is on the destination-based side, because actually it's not a tax on the source-based activity anyway. So the tax on the source-based activity is 0. That's extraordinarily dramatic move in the tax competition game. I know that the US hasn't reduced its tax rate for a very long time, but this would be a pretty dramatic response to what everybody else has done over the last 30 years. This seems to stop working, but oh, there we go. So let's think about it. So suppose the US does this, but nobody else does it. How's that going to affect US companies and companies in the rest of the world? So US companies importing to the US. Take a company in the UK which wants to sell into the US. UK's still got a conventional corporation tax. It'll pay tax on its, on its conventional source-based system in the UK. When it gets to the US, there's going to be tax on the import as well. So that's pretty bad news for people producing elsewhere and exporting to the US. What about the other way around? Companies exporting from the US are not going to pay tax in the US because they're exporting and it's going to be zero rated. Actually, they're not going to pay tax in the place to which they're exporting either, because they've got a conventional source-based tax, at least a corporation tax. They may have a VAT. So initially, at least, the US is going to be, an extraordinarily attractive place to do your business and do your production. You wouldn't want to be anywhere else in exporting to the US. Neither would you, but you would want to be in the US exporting elsewhere. So that's got to be good for American activity. What's going to happen, now let's go back to what other governments are going to think. Well, they're going to be furious, frankly. The US has just reduced its tax rate from 35% to 0. So, okay, you're going to have to deal with that. And, Bob's going to have to go back to the OECD and explain it to them. So that's not the easiest task, probably. But actually, suppose the US actually did do this. How the other government's going to respond? Well, the obvious response is to do likewise. Actually, if you can't beat them, join them. So, the UK, the best response from the UK would say we have to move to a destination-based system as well. And if they did, then they would no longer be taxing UK companies which wanted to export to the US. They would be taxing US companies which wanted to export to the UK. So, the UK would then start to collect some tax revenue again, and they would then take away the kind of disadvantage to UK companies relative to US companies. And I guess all other countries would be in a similar kind of position. So an important thing here is really, and one that we thought about a lot within our group, this is kind of self-reinforcing incentives for adoption. So, when we've normally thought about international tax reform, and we all go to Paris and kind of sit around a big table, or Bob does, and I kind of look from afar, and everybody's got to try and agree on something. But governments are, inherently they face this trade-off. And on the one hand, it's a good thing to agree and coordinate at the OECD or elsewhere and come up with rules to prevent tax avoidance. On the other hand, those governments are competing with each other and they're reducing their tax rates. My country, the UK, has been particularly adept at doing both of those things. On the one hand, it's played an active role in the BEPS process of the OECD. On the other hand, when they finish that, they go back to London and they kind of invent ways of competing with everybody else. And we've reduced our tax rate from 28% to 17% over the last 5 or 6 years. Of course, at the same time, we've introduced the diverted profits tax because we're kind of a bit confused about which direction we should be going in. So on the one hand, we do want to kind of collect some tax revenue. On the other hand, we want to compete. So that's kind of, we do that because we have a source-based system. We want to attract real activity and some revenue. This system, in principle at least, when you write down the nice economic theory, it all kind of seems to be incentive compatible. This is a good thing. If you have this kind of thing, other people will want to join you. Other people will want to have a destination-based tax as well. And so, we think the DBCFT exhibits incentive compatibility in the sense that, if other countries have got it, you probably want to have one as well. And then there's no particular reason to undermine that system by reducing a tax rate. When the tax rate is more or less irrelevant then within this system. And as evidence from that, I'd say, look, we don't observe competition in VAT rates around the world. We do observe competition in corporation tax rates. Why don't we observe competition in VAT rates? Because it's on a destination basis. It's where consumers are, and there's not much they can do about it. Finally, just a final note on one of its properties, is that this is, in principle, at least a highly progressive tax for the reasons I think have come up already. This is a tax on, effectively, it's a tax on consumption from sources other than wage income. And it's other than wage income because we're giving tax relief for wages. It's a tax on economic profit in a particular country. And, has been mentioned, that's going to be highly progressive. There are innumerable implementation issues, so I just kind of listed some of here, how we're going to deal with financial services. The problem of losses has been mentioned. If you're kind of producing in the US and exporting all of your products to the rest of the world, then you're going to have a taxable loss in the US, even though you're profitable overall. We have to figure out how to deal with that. There are issues of source-based rents, which we could talk about. That is, there are cases where there are clear rents or profits available on a source basis. The most obvious of those is the kind of natural resource. If you have a diamond mine in your country, you probably want to tax some of the returns from that independently of this tax system, which is only going to be based on destination. There are the WTO issues, which came up already, and there's, how do we tax imports by domestic consumers, which is a kind of problem with VAT at the moment. But if I'm sitting in the UK and I download something from Amazon, and then in principle the UK wants to collect VAT on that, now it would have to collect DBCFT on it as well. So those are all kind of big and complex implementation issues, which we can talk about more if anybody would like to. Otherwise, I'll just conclude. So, viewed from the perspective of afar, I think, and it's quite interesting. When I come to the US and I come to Washington, DC, I'm always kind of pleasantly surprised by how much people are willing to talk about fundamental tax reform. Actually, if I go to London and talk about this, they all kind of wave me back to my ivory tower in Oxford and say, look, this is never going to happen. If I go to the OECD, they say the same thing. Actually, when I come to Washington, people are quite interested in talking about this stuff. Problem is that actually, when I come to Washington, DC, it's the kind of place where actually nothing ever happens in terms of actual tax reform. So maybe things are different now, perhaps. So I think the existing US system has lots of problems, which everybody has been talking about. But this is at least an interesting option for further exploration. I'll stop there.
Thanks very much, Mike. Okay. Well, maybe we could just ask a couple of questions before throwing it open. I guess one is kind of In a way, following up on the point that you made about the equivalence between destination-based cash flow tax and a VAT combined with a kind of wage subsidy, as Kevin was saying. So are there kind of any economic or legal merits in going through something called a destination-based cash flow rather than saying, let's get rid of the corporate tax, have a VAT, cut wage taxes? And in a way, on your incentive compatibility point, is that in a way already what a bunch of countries are doing, not in Europe, they're trying to move from the VAT, we move from labour taxes to the VAT. I don't know.
The big picture, I think, is exactly that, actually. I mean, if you look at what's happening around the world, there's competition on corporation tax rates. Governments need some money from somewhere, and where they're going, they go to a tax that they can raise some money on, which is VAT. So why are they doing that? Because of these kind of extraordinarily powerful economic forces. This is happening anyway, I think I want to claim. Corporation tax rates are going down, VAT rates are going up, kind of everywhere outside the US, I think, and that's because of those powerful economic forces. Now you can just kind of leave that to go, and I think ultimately we will get to the same kind of position where we're relying much more on VAT and much less on corporation tax. Or you could say, okay, well, let's kind of observe that's happening. Let's actually think hard about how to put that in place. I think then you're right, then there's two ways of doing it. You could think of it as a corporation tax where we're going to make these adjustments of the kind which I've talked about, but we're still going to call it a corporation tax. Or you could, what's economically equivalent would be to say, as I said, I mean, this is like a VAT and a subsidy to labour, if you like, because a VAT would tax the economic profit and it would tax labour. So if you introduce a VAT, then but you only want to tax the profit bit, you have to reduce taxes on labour. Economically, I think they're the same. Legally, the WTO thing comes up. We know that a VAT is perfectly okay with respect to WTO rules. Cutting your payroll tax is also okay with respect to WTO rules. So, we economists get somewhat puzzled about why the WTO may say, okay, you can have a VAT and a payroll tax subsidy, but you can't have a destination-based cash flow tax, which is economically equivalent. But who am I to argue with that? I'm only an economist.
Right. Me too. We all share. One other thought I wanted to run past you was a lot of the discussion we've had today seems to be about the idea we want to tax rents, basically. And at least one difference between some of these proposals is where we do it, kind of who gets to tax the rents. So you mentioned some rents we probably think have some kind of location kind of tied to them, like natural resources. So we kind of maybe want to allocate those there. I know, and I guess another approach to kind of the other rents is a kind of phrase that is a dirty word in Paris, but we're allowed to say it here, which is formula apportionment. So we have the CCCTB proposal in Commission. As you know, we've thought about it a bit on the group, the idea that says, well, okay, as Ed's saying, these multinationals have these global rents. So how can we allocate those? Why don't we, in the longer term, think of allocating those rents across countries by some formula? Maybe take out some bits of profits we can allocate by more or less standard arm's length pricing, spread out the rest between countries by some formula. Which, in a way, you could say, well, one view of the future is your vision of the VAT rising and labour taxes going down. Another one is to say, well, suppose we carry on the path of the world. Suppose we carry on the path of the world becoming more like a big federal country. We know all federal countries have formula apportionment of some sort. Maybe that's where we're going to end up. So maybe you can say a bit about thinking on the kind of more formulary-based aspects of approaches.
Yes, I think there's several questions in one.
Well, but it was. I think it was one incoherent.
Okay. Well, let's kind of think about formula apportionment first. I mean, that's. So, I mean, a lot of these proposals are all trying to kind of deal with the kind of same problems, and it's a perfectly reasonable way of thinking about how to do that. There are kind of different ways that one might do that. I think the CCCTB proposal is to say, like other formula apportionment systems, multinationals within Europe would work out their European-wide profit. So you don't need to say whether you made it France or Germany, Italy, anyway. It's just you make this in the EU. Then we allocate that. We allocate it to individual member states on the basis of some formula. The EU proposal is a kind of classic three-factor formula, and then each individual member state gets to tax out of their own tax rate. So that's the kind of basic idea. That clearly solves a lot of problems. It solves most of the transfer pricing problems, at least within the EU, although not between the EU and the rest of the world. It doesn't kind of deal in the same way as the kind of destination-based cash flow tax does in terms of kind of neutralities, but except to the extent to which, it depends what goes into the formula. So on the one hand, if you say we want to have some kind of element of source-based tax, then you'd want to have some element of the source base into the formula. So you might have, the number of employees or capital employed in the formula. But the extent to which you do that, then you've still got some kind of competition problems, and you're still going to have distortion to where real activity takes place. The extent to which you say, actually, the only thing we're going to put into the formula, as I understand, is more and more the case in the US states, is sales. Then you get back to something much more like the destination-based cash flow tax, but on a kind of slightly different basis. It's not quite the same, and there are kind of different issues of implementation, I think. Right. So, as you know, one of the other, we've kind of thought about two proposals within our group in some detail. One is the destination-based cash flow tax. One is what we call the residual profit allocation. The idea within that is to kind of borrow a bit from formula apportionment. So in that sense, that proposal would say, okay, we will allocate some tax revenue to the place where production takes place as source country. We'll do that by using rules which are okay within the transfer pricing system, which is basically a kind of cost markup. So we identify costs that you have in the US, say. We could allow them a markup that would give you some kind of level of profit in the US where you're actually doing your production. Then we work out the residual profit on top of that. So if we kind of work out that kind of residual profit all over the world, and then take that away from your total profit, the rest is the kind of residual profit. You can then allocate that residual profit on a formula apportionment basis, and one way of doing that would be by sales again. That too has kind of quite a lot of nice properties. It's kind of intended to try and get around many of the transfer pricing problems that we have at the moment. So there are certainly other ways that you could think about that.
Right. Thanks so much. Well, let me open it up, see if there are questions or comments from Mike. Why don't we go to David at the back?
David Wentworth, IMF. So what are the opportunities for gaming this system, since tax lawyers and even tax economists are pretty good at always figuring out a way to get around it?
Well, it's quite hard to come up with them, actually. So, some of the people we've got in our group, their professional lives have been devoted to gaming tax systems.
That's why they don't like it, right?
And actually, in the course of the discussion, they've come up with things. So, for example, when we're talking about, should we apply this on a real basis, or R plus basis, or an R plus F basis? They didn't like the R plus F basis on the grounds that actually nobody would pay any tax, because, the companies, effectively the way it would work, if companies could just deposit their profits in a bank account, that would be tax deductible and they wouldn't pay any tax. So we have tried to think quite a lot about this within our group. Beyond that, they haven't mentioned anything so far, and they've been kind of quite hard pressed to come up with things. So it's not obvious how you do it. And similarly with VAT, if you ask the question now, how do you get around VAT? Well, there's kind of the margin, there may be carousel fraud, but those kind of things which, then that's a kind of question of the kind of design of the implementation, where you're really getting down to the specifics of how it's done. But I don't think there are any obvious ways you can game it.
Sorry, Kevin. Yeah.
It's actually a question for both of you. Could you kind of layer in exchange rates into the discussion a little bit?
Oh.
Sorry.
Do you want to say something more than me?
You want more on this, me.
Okay. Well, okay. There's a question which kind of is sometimes posed. Suppose we think of a US company which is producing here and selling abroad. We're giving tax relief here on the kind of labour costs, but we're not taxing that income. They're going to have a taxable loss, and if it's a kind of neutral system, we actually have to give relief for that loss. So, and you might actually think, oh, well, if you've got a high US tax rate, you're going to get more relief for that loss, and therefore, this would be a higher tax rate would be a good place to come. So the reason why that's not true is actually we expect changes in prices. So, one way of thinking about that, even with a fixed exchange rate, suppose that world price of let's think first of all, small open economy, the world price is fixed. When you're kind of selling that good into a small open economy which has a destination-based cash flow tax, that's going to push the higher the tax rate, that's going to push up prices. So in equilibrium, what we'd expect is that prices will go up, prices of outputs would go up, but also the price of labour would go up. Because we're only taxing economic rent. If we're thinking about labour, if we're thinking of VAT, then the price of labour wouldn't change, but in this case the price of labour would go up. So basically, we'd expect the price of labour to go up. That's going to offset this kind of tax relief, which is why the net effect in terms of kind of neutrality where investment will take place is that it would be neutral. So we do expect, so those kind of price effects we would expect to happen. They happen much more easily through an exchange rate effect because, if there's a fixed exchange rate, you really do have to have kind of nominal changes in wage rates. That would take, some time to filter through. With a flexible exchange rate, it can happen more or less overnight with changes in just changes in the exchange rates.
Sorry, Eric, I think you had a...
Thank you. As you know, capital income is taxed at both the firm level and the individual level, and there are provisions in the House blueprint. But I was just wondering how you envisage capital gains, dividends, and interest of individuals being taxed under this plan.
Right. So we've tried to focus just on the kind of international side of corporate tax and basically leave that to one side. So we're not really proposing any changes to kind of personal income taxes, mainly on the grounds that, we don't want to kind of design a whole tax system. We just want to focus on the corporate tax. I don't think the destination-based tax kind of makes things any worse than the existing system. I mean, it is true that there was, the problems of, how you're going to tax capital gains, how you're going to tax dividends, and so on. There are problems there which will continue to be problematic with respect to kind of personal taxes. But I don't think they become any worse. But we're not really proposing. On the other hand, we're not really proposing any ways of, of relieving all of those. One could go to other systems, which are more focused on those.
Mm-hmm. Please.
Thank you. My name is Li Yang. Thanks for your presentation. You have a lot of good point. But I think in the system, whether it is in the United States or overseas, there's a biggest problem, and I think probably now President-elect maybe have a problem too. When people reminded him about the problem about Department of Justice, then he'll back up or about what he thinks should fix the corruption. So for tax system, because a lot of things is not because people don't pay tax, but because abuse, not just a collection agency like IRS or Comptroller Office, but by the phony attorney or phony accountant, they abuse or propose legislation, or even there's no such a legislation, they abuse something, make up phony stories. So I just wonder, currently, is there any effort to propose such fixing the system in such a manner to fix the abuse or corruption, really do the things like if you have task force in Ways and Means committee, if you have task force to cooperate to fix the system, really fix the system, so in such a way, so people, they can have assets or equipment, or they can have time or resources to enjoy family life. This will be a super plus in our effort to fix the system, plus we have a lot of revenue left.
Well, I think our proposal is not going to help here. Well, I mean, there may be other things in the blueprint. I mean, but you're talking about tax evasion of kind of individuals and businesses within the US. If people are going to evade taxes, then they're probably going to evade the destination-based cash flow tax as well. And there's no.
I'm talking less about individual innovation. I'm talking more abuse by other parties, like third party or IRS.
Okay, I think I have the same answer. I'm afraid I'm not going to solve that. I'm certainly these proposals I'm talking about here are not going to solve that.
I thought it solved everything, this proposal.
Oh, but actually, that's true, right? Apart from that.
Just one question that came up briefly. I think Barbara mentioned this on your slides. Could you say a bit about losses, the plan to deal with losses? Because there can be permanently profitable firms and permanent big loss makers.
Yeah, so this is clearly an issue because as you say, you could be a profitable firm but have taxable losses in the US, and they could be permanent.
Yeah.
So just carrying forward the loss is not going to solve that problem because you can carry it forward and just get bigger and bigger, but you can never offset it. You never have any income in the US to offset it. On the other hand, if you'd say, okay, well, that's tough, you're not getting any relief for losses, then actually the kind of properties that you claim for the system of neutrality and efficiency don't hold either.
Right.
So in order for this to work, that problem has to be addressed. The kind of things that we've thought of for doing that are really mostly along the lines of, it relates to the VAT and payroll tax idea. So, if you have a taxable, suppose you think of it as suppose it was implemented as a VAT and a payroll tax, then the problem would kind of disappear because the VAT payroll tax element would be we introduce a VAT and we reduce payroll taxes. So what would happen? There would be no loss on the VAT side, but you've given up all these payroll taxes, so there's a kind of net negative effect on US tax revenue. If we did it as a corporation tax, you would have a taxable loss within the corporation tax system because actually that kind of reduction in payroll taxes effectively is your taxable loss. So one way that you could deal with that is to say actually, well, you could offset that taxable loss against other taxes that the company is paying, like payroll taxes, and that would kind of be equivalent. That would be more equivalent even to VAT and a payroll tax.
Yeah.
But it's certainly an issue that something that you'd have to have rules permitting that kind of thing to happen.
Okay. Is there any more questions? No more questions, comments? Well, then it falls to me to close the day, to thank AEI and Kevin for hosting this fabulous event, and my colleagues for helping organize it, to Mike and to all the speakers. So join me, please, in thanking you.